Okay. Good afternoon, everyone. Welcome to this call on the BlackRock Greater European Investment Trust. I'm extremely excited to be here talking about a strategy that will give local South African investors access to two high-performing equity teams at BlackRock, basically a vehicle to invest in the best investment cases across Europe without using offshore allowances. So the purpose of this call today is really to address a couple of questions. First of all, I'd like to touch on what differentiates BlackRock from other asset managers. I would like to introduce the European equity team and the rigorous investment process we follow. And most importantly, I'd like to talk to you about why we believe it's a really opportune moment at the moment to invest in European equities and in the region in particular. Lastly, I'll give you an overview of how the strategy is currently positioned and where we have our areas of conviction at this stage. Okay, very briefly, BlackRock, as many of you will know, is the largest asset manager in the world with close to 6 trillion assets under management, and that's in dollars. The European equity team sits within the active equity piece. You can see there at $300 billion. And within that, we are the largest team on the fundamental equity platform, managing $44 billion. I've been part of this team for over 10 years now. And so very often as an investor of the European equity team, I get the question, what differentiates BlackRock from other asset managers? What are the benefits of being part of this organization? And while there are many things that come to mind, like our state-of-the-art trading capabilities, our systems and technology, as well as the scale, for me, it boils down to three things that really make a key difference. Firstly, corporate access. We very often end up being the biggest shareholder in the companies we look at because we have a large active as well as passive business, and that really gives us unparalleled access to management teams as and when they come on roadshows through London and Edinburgh, because quite frankly, they always want to see us because we're one of the biggest shareholders on the register. And so as a team, we do over 1,000 company meetings per year, and that's really a very valuable source of idea generation as well as investment insight. Secondly, we have a lot of very talented investors across the firm, and our top management has placed a very big focus for many years now on connecting all those different investment teams across the globe. So, for instance, as a senior investor of the European equity team, I sit on a senior investor meeting on a Monday morning that connects me to investors in Hong Kong, India, Australia, as well as other geographies. And really what that allows me is to get, again, insights from the local regions, from people who are on the ground, very important when you invest in European equities, because a lot of our companies generate their business abroad. Thirdly, and that's really looking into the future, as a company, we're making big investments at the moment into data analytics to equip our analysts with more tools to analyze data and gain insights on the companies we invest in. And we believe we are ahead of our peers on that front. So let me now come to the European equity team. It's quite a unique team. It's one of the best resourced in the market. It consists of 20 investment professionals covering the entire market. There's a huge amount of experience within this team. So we have 7 senior investors with more than 15 years investment experience. We also offer the full suite of products in terms of flexible income, value, growth, as well as long-short products. And that really allows for real diversity of views and strong investment debates when we come together and discuss individual investment cases. You also see all the sector analysts on this sheet. So we cover the entire market by sectors. And all these people have covered their sectors for a very long time. If I pick out one name, for instance, Brian Hall, he's our industrials analyst. He's been looking at industrials for over 15 years, and he sees those management teams every quarter, so he can spot when there's change, when the body language softens, when they become more cautious about their outlook. And so in those over 1,000 company meetings we do, we basically gain a lot of very valuable information, which we can then take back and put into our proprietary models, because we do our own research templates for every single company we invest in. So the ultimate goal of this team is to build a high conviction portfolio that give our clients access to the most compelling investment cases across Europe. This is just to give you an overview on how we have organized the team. So the team, as I said, is organized by sectors. We call them the research pods. You can see there's 7 different verticals with subsectors, which allows for very clear alignment of responsibilities. And the job of the analyst is then to identify the most compelling investment cases in their respective sectors. And by that, we mean the companies that can outperform the markets on a sustainable basis. And that's also how our analysts are remunerated, because basically they're being paid on the alpha they generate for all the different strategies on the team. What's also important to point out is that the PMs and analysts don't work in isolation. We follow an approach where the PMs are getting involved in investment ideas and research from a very early stage. And that's really a key part of our strategy and philosophy. And the senior PMs, as you can see, are the leaders of these different research pods to ensure that the analysts are looking at the right stocks at the right time, that cross-check some of the assumptions that go into the models, as well as to help put recommendations into a portfolio context. Let me now just spend a little bit of time on our investment process. So it basically, as you can see here, it's a 3-step approach, with the first step being the idea generation. And that's really driven by the number of company meetings we do every year. That's a primary driver of the ideas that are coming through the research platform, again, because we get such valuable information by meeting all these management teams, and can really piece a complete picture of the entire market by meeting managements and companies across all the different sectors in the market. Secondly, there's an element of screening, and to a lower degree, we use external research providers like sell-side brokers. From there, we create what we call the research pipeline. It's basically the strongest ideas at any given time, and each analyst has one name assigned to their name. And again, we want to ensure here that the analyst looks at the right stock at the right time. We want to be commercial by prioritizing our research hours as effectively as we can. The second step then is for the analyst to go back and produce what we call the research template, which is basically a proprietary model that is being presented to the team. It's a financial model, goes into a lot of detail. It's the end result of all the insights we've gained in this process. And it can be actually quite a scary prospect for the analyst, because he comes to the table with an investment idea and is then being challenged by all the senior investors around the table, who challenge the assumptions, who challenge the thinking that has gone into his numbers, and also the recommendation. The end result of this process is to have a very clear rating on a particular stock. We rate stocks from 1 till 5, 1 being strong buy, 5 being sell, and also a price target, so that at any given time we know exactly what we think the fair value and the upside in a particular name is. The third and final step is then to put that idea into a portfolio construction context. So it's important to point out that as a portfolio manager, I don't have to then automatically buy what has just been presented to me. The ultimate decision rests with me as a portfolio manager, and I have to think about how this new idea changes the risk characteristics of the fund. And our systems allow us to do this, because I can go into the system, do pre-trade modeling to see how any particular idea changes the beta, the style risk, the industry risk, country risk, and so on. So even before I put a stock on, I know exactly what the fund is going to look like after I've put through the trade, which I believe is quite a powerful tool. Here we just give you an image of what we call the research template. So it's basically a standardized format. All investors are familiar with where they find all the relevant information. You can see on the left-hand side there, we see a summary of the investment case. We have a section on analyzing the market drivers. We know exactly what's going to drive revenues, earnings, and cash flows. And again, at the end, we have a very clear rating system from 1 to 5 and a price target that signals conviction as well as the upside to the fair value in that particular stock. We're basically covering all aspects of an investment case while ensuring that these ideas are being delivered to the team in a timely manner. And on the right-hand side here, again, going into portfolio construction, is this internal system I was referring to earlier, which is called Impact, that allows me to look at my fund on an ad hoc basis every single day. I know exactly what the risk exposures are I'm running. I know exactly how much is coming from stock specific, how much is coming from style, country, industry. And in this system, I can also do the pre-trade modeling to see how a new idea would change the risk characteristics of the fund. And this is a good moment to just step back for a second or two, because what I want you to understand is that when BlackRock was founded in 1988, their mission statement was to create the most respected investment and risk manager in the world. And that really hasn't changed. They have invested in the risk capabilities of the firm ever since. And so we have an independent department, which we call RQA, that consists of over 80 risk professionals, whose only job it is to analyze our funds from a risk perspective. And that's really a key part of the portfolio construction process at BlackRock. And the objective here is to ensure that the risks we run are deliberate, scaled, and diversified. We want to run intelligent risks for our clients. And most importantly, at any given time, we want to fully comprehend all the contributors to total risk. And we want there to be no blind spots within the portfolio. And there's a very rigorous process here. We meet our risk colleagues every month, and they ensure that everything is run in line with the guidelines and that we fully understand what is going on. Now, let me now come to what's probably the topic everyone is most interested in. Why is it a good time to look at Europe right now? And why does Europe remain a highly attractive region to invest in? Now, the first point to make is when you look at listed European equities, they source 60% of their revenues from outside Europe. And therefore, as a group, they're very much geared into what we are currently seeing as a synchronized recovery around the globe. And when I look at the macro data, it remains incredibly strong. It's accelerating in some regions, but if we look at all the different regions around the world, the US looks strong, Japan looks strong, China is still at a very high level, emerging markets look strong. But most importantly, when we look at Europe in particular, we see very many indicators that are hitting multi-year highs, whether it's the German IFO index, Italian manufacturing, which hit the highest since February 11. The PMI's employment sub-index hits the highest level on record. And so what we're seeing is that this recovery appears to be broadening out as it's driven by all countries, sectors, and all the different pillars of demand, especially private forces at home like household consumption and investment. And so when you then look at the first 3 quarters of 2017, the Eurozone actually grew at an annualized pace of 2.4%, which is not only well above its trend growth of about 1.5%, but it's also putting the Eurozone ahead of both the US and the UK for the first time in a very long time. And we see this continue. There's no signs of overheating. Wage inflation remains relatively low. There is still slack in the manufacturing capacity, and we still see pent-up investment demand across the different countries. And importantly, when we look at some of the forward-looking indicators, like new orders, they're still pointing to reacceleration of growth. And this is what some of our companies are telling us as well. It's almost too good to be true, but into Q4, for quite a few of them, we're seeing a reacceleration of the demand and therefore also of the growth. And what's very important from an equity perspective, we're seeing this positive macro backdrop feeding through nicely in corporate earnings. So when we look at that left-hand chart on this slide, we can say that we've seen the strongest earnings development we've seen in very many years. I think it's the best earnings growth we've seen since 2010. And the same applies to earnings revisions for the market as a whole, which have been very, very stable year to date, which comes as a stark difference to what we've seen the previous 5 years when earnings got consistently downgraded as we went through the year. Now, again, this is what we've just seen, but when we look forward at 2018, let me tell you that for the Stock 600 aggregate earnings, the market currently estimates 8% growth for 2018. For the Stocks 50, it's not much different. Now, when I look at all the different indicators we're looking at and speaking to all the companies we speak to, I find that rather unambitious and beatable as a forecast. And so that gives me a lot of confidence that there is more to go with regards to positive earnings surprises going forward. And what we're showing you on the right-hand side is what has been driving equity returns in Europe year to date. And as you can see on that bar on the very right-hand side, it's all green. It's all coming from earnings change. And that tells you that we're back into a stock pickers market, that the move in stocks is primarily driven by the earnings revisions we're seeing, which is the ideal scenario for us because the key strength of our team is to identify businesses where the earnings power of the business isn't fully reflected in earnings forecasts. That's what we're really good at, and that's the type of portfolio we're looking to build. The last and also, again, very important point on Europe is we see political risk receding. We had 3 sets of quite important elections this year. They all turned the right way. We equally see very strong reform momentum in France at the moment. And this is really filtering through into some other countries as well and will eventually lead to stronger reforms at the European level as well. And with that, the equity risk premium on European equities has already been coming down, has more room to come down. And therefore, it's no surprise that flows into Europe as an asset class have started to reaccelerate. And you see that on the right-hand side. Now, again, just to give you a bit of context, 2016, with all the big events like Brexit, the asset class, European equity that is, lost 85 billion euros in total. It took until Q2 this year for that to turn. We basically saw reacceleration of flows after the French elections. And this has moved quicker yet again from Q3 onwards, which so far has been the strongest quarter for flows for our team. We know that a lot of clients are still sitting on cash. We believe that with this combination of strong macro backdrop, strong earnings progression of the corporates and political risk receding, these asset flows are going to continue accelerating into year end. Lastly, on valuation, we think on the left-hand side here, you see the MSCI Europe forward price multiple at 15 times. You can't say it's extremely cheap, but it's also not expensive. And it has to be seen within the context of other asset classes within the world. So in the middle, you see the chiller PE of European equities relative to the US, and you can see how there's still a significant gap between those two regions. And it also has to be seen relative to fixed income markets, where the dividend yield on European equities looks very attractive when compared to the yields currently on offer in sovereign bond markets. And I often give this example, but with BlackRock being a big fixed income investors, we know for certain that some of our fixed income colleagues are buying low risk equities for yield pickup because there's no yield to be had anywhere else. And that in itself, I think, tells you that our market still remains attractively valued. Let me just talk very briefly on emerging Europe as well. I'm going to give you a more detailed overview of the BlackRock Greater European Investment Trust in a second. One of the unique features of this trust is that we can invest up to 25% of the risk budget in emerging European equities as well. And when we look at that part of the market, we often talk about a lost decade because basically those markets have not gone anywhere for the last 10 years. Last year was the first year where they had decent performance. It was all driven by earnings. But when you look at that left-hand chart again and the PE of the MSCI Emerging Europe, I think we can say that this is remains one of the cheapest equity markets globally, currently trading on an 8.7 to 8.8 times forward earnings multiple. And also, these companies are offering dividend yields of 6 to 8%, which are increasingly covered by free cash flow, because what we're also seeing in that region is that they're becoming increasingly better stewards of capital. And you can see that on the right-hand side, meaning that there's less spending on trophy assets and more focus on free cash flow generation. And so what that gives you is quite a powerful combination, because for a lot of these countries, they offer faster economic growth, they offer therefore potential for quite significant growth in earnings and free cash flow, and therefore, at very, very cheap valuations that is coming through in those dividend yields and PEs. So let me now talk very briefly about the BlackRock Greater European Investment Trust. Again, we believe it's quite a unique proposition. It's giving you access to the strongest investment ideas coming out of two highly successful teams, the developed European equity team as well as the emerging European equity team, which is headed by my co-manager, Sam Becht. And it's unique because there's no other strategy out there that has that combination of developed and emerging. Now, to be clear, 75% of the trust will always be invested in the developed European piece, which I look after. But it's quite a powerful opportunity set we're looking at. So the addressable universe is over 2,000 companies. And our job is really to identify the 35 to 45 most compelling investment cases in Europe. And what we often talk about is that we want to create competition for capital. We want to make sure that any holdings we own in the trust are the ones that have the biggest amount of upside to fair value, to really build a high conviction portfolio, giving access to the strongest investment cases across Europe. As I said, the trust can hold up to 25% of its risk budget in the emerging European piece, and the asset allocation between the two regions is really done by Sam and myself. We sit down on a regular basis and look at the opportunity set in those two parts of the market and decide, where to invest. Given that it is investment trust, we also have kind of the typical investment trust toolkit available to us, so we can gear the trust up to 15%. And we really do that on an opportunistic basis, when we see fit. It's an investment decision, but we can put the foot on the accelerator if we think that the environment is conducive to generating additional alpha by using gearing. Just briefly on performance, you see here historic performance of the investment trust has been strong. So the 5-year performance relative to the benchmark is about plus 4%. Over 3 years, we've outperformed the benchmark by 7%. Year to date, the trust is up again around 2% relative to the benchmark. Also, I understand that that the Stocks 50 is a relevant index that investors in South Africa look at. And against that index, outperformance has been even stronger with 11% outperformance over 3 years and 7% outperformance over 5 years. Now, when I look at that top bucket on the right-hand side, the stocks that have really worked for us over the last 3 years, they are examples of some of the best businesses that Europe has to offer. They are often very global in nature in terms of where they do business. But what they all have in common is that they're fast growth, they have high returns, high free cash flow conversion, and strong management teams with a very clearly defined strategy for value creation. And again, when I look at them, the reason why they have done well is that the earnings power of those businesses wasn't properly reflected in consensus forecasts, which led to positive earnings revisions and therefore positive share price performance. That's exactly what we're looking for in this strategy. Coming to positioning, you can here see the sector positioning of the investment trust as per the end of September. Now, again, sometimes it's helpful just to step back and articulate how we go about constructing the portfolio. And the first thing to say is that when you're building a high conviction portfolio, you need to embed long-term thinking in the fund. because we believe that the bottom-up fundamentals only really dwarf short-term volatility over the longer term. Also, what it means to build a high conviction portfolio is that at times you step away from certain sectors completely when you deem the industry fundamentals to be unattractive. And when you look at the trust here, you can see that we've been consistently underweight certain sectors like utilities, basic materials, telcos. And so, the explanation really is when we look at these businesses, they're typically lower growth, they're quite capital intensive, they're low return with some degree of regulatory risk. And most importantly, the management teams of these businesses, and I'm generalizing a bit, are typically not in control of their earnings and cash flows. So if you're a utility company, the price of energy is set by a regulator. The only way you can surprise positively is by taking out more costs than the market thinks, but ultimately you're a price taker. If you're a steel company, which sits within materials, the price of steel is set globally. You're incredibly reliant on what happens in China with respect to demand and in terms of how much they export and import. And the raw material piece, which is a key part of your earnings driver, is also extremely volatile. Again, price take on that front. And so what you find is that over the cycle, some of these businesses simply fail to earn their cost of capital and generate value for shareholders. So when we go about building a high conviction portfolio, we do that two ways. It can be via large active positions in individual stocks or by running big sector bets or a combination of the two. And this is really just to give you an idea of what current areas of conviction are within the fund. Again, there's a lot going on at any given time. We currently own currently running about 37 positions. This is just to give you a flavor and outline some of the exposures we're currently running in the strategy. And we come to those ideas from the bottom up. We're not thematic investors. We just put them into categories for you to illustrate some of the exposures we're running. And you can see there is decent exposure to what we believe is a very clear recovery coming through in European construction. At the moment, it's late cycle. The order books are moving up. Investment is going up. I've already talked about that earlier. And we see that continuing. All the lead indicators are pointing to continued growth in that area. On the emerging markets, again, we came to these names like Richemont, Kering, Rémy Cointreau by meeting the management teams every single quarter, by building our own models, ending up 10, 15% of consensus in the outer years, and believing in the strategy that was put in front of us in the meetings. Kering is a prime example. Their sales momentum inflected in Q4 2016. They've been turning around their Gucci brand that drives about 60-65% of the earnings. When I was in South Africa in August, we were talking about how our web scraping tools were highlighting a dramatic increase in search activity for the Gucci brand. They've just reported Q3 results 2 or 3 weeks ago. Expectations were extremely high. People were expecting the brand to grow by about 31% on what was already quite a tough comp, and they grew by 49%, really smashing numbers. And we look at it on a 2-year stack basis in terms of the comps, the momentum is continuing really strongly. Importantly, the other brands are also doing well. So Yves Saint Laurent, Bottega Veneta growing really nicely, and they're in the process of selling their Puma stake, which is worth over 4 billion euros. And when they do that, they're very likely to return that cash to us as shareholders. So that's a name we still feel very strongly about. Straumann is another name. It's a very nice example of some of these leading businesses we can find in Europe. It's in the medtech sector. They're the global leader in dental implants. They hold about 25% market share. And they're growing 16% organically at the moment because they launched a couple of new products like a bone level tapered implant where they're taking lots of market share, penetrating all of their regions, but again also in the process of launching 3 or 4 more products that will sustain that run rate and growth going forward, which is really important. Again, we see them every quarter. We know exactly what they're up to. and we've got high confidence in our numbers here being above consensus again in the outer years, while they're executing really very well. So I might just take you through one of the examples we currently own on the construction side. It's a company called Eiffage. They're almost 100% exposed to the French economy. They run a French concessions business, so that's motorways, as well as a construction business. The concessions piece accounts for about 25% of revenues, a bit more of earnings. And so far this year, we've seen very good momentum coming through in terms of traffic growth as well as pricing. So they've surprised positively on that part. But the key reason why we wanted to own this company was that they basically had a new management team a couple of years coming in, focusing on the construction activities. And what became very obvious, and they give exposure to all the different subsectors within construction in France, so residential, non-residential, infrastructure. So as and when we saw all these companies, French construction companies coming through at the beginning of 2017, like Bouygues, Vinci, Eiffage, it became very obvious that there was a strong recovery coming through in private sector demand, a very solid pipeline as well in terms of large infrastructure projects like the ring road around Paris, Grand Paris, as well as stabilization of the spending in the local authorities. And you can see that on the chart on the right-hand side, how their order book and the order intake trended really positively from the beginning of this year, and we have seen that continuing. Again, they reported numbers last week. Their top line is growing about 7%, which for a construction company is very decent. And the order intake is 9-10%. So again, outpacing actually the growth that we've currently seeing, giving you very strong visibility on future growth in the business. And what our analyst believes is that, as and when that growth materializes and accelerates further, we see that operating leverage coming through, leading to better margins and better profitability, which is not fully captured by the market. So let me just finish on our top 10 holdings. You can see here the top 10 active positions in the trust at the moment. And the helicopter view on this group is it's a very diversified group of businesses. We're tapping into different income streams and different end markets, cash flows that are sourced in multiple different ways. And the common factor for all of them, we see opportunities for growth, we see opportunities for improving returns, and most importantly, again, we believe that the earnings power of these businesses is not fully reflected in current consensus forecasts. And if I just touch on every single one with a one-liner, Lonza is a leading Swiss manufacturer of high-end biologic drugs for the likes of Roche and Bristol Myers. We think their EBIT can double over the next 5 years, which would be in 15% CAGR. We're very confident in the management team there, executing extremely well. Fresenius Medical Care, listed in Germany, is the leading dialysis provider in the world, especially in the US, where the obesity epidemic is particularly prevalent. Now, the one thing I want you to take away on Fresenius is that the US is increasingly moving to what we call value-based care. Now, you try and find a company that gives you exposure to value-based care where governments want to save healthcare costs. You will struggle. And this one, for me, is the key play on value-based care because they're already running pilot programs with the government. They're achieving $7,000 of savings per patient, and they will be keeping half of that, and the other half goes to the government. So that's, again, one I want to own for the next few years because that will become an increasingly important part of the earnings. DSV, freight forwarding business, doing extremely well. They did an acquisition called UTi. Again, reported numbers last week came through better, about 8% on EBIT, but most importantly, the synergies of the integration is coming through a lot faster than we think. Our analyst reviewed his numbers post the release, and we stay 7-8% ahead of consensus for next year. ASML, might be a name people are familiar with. We had the CEO in 2 weeks ago, extremely bullish meeting, almost scarily bullish. He's talking about insatiable demands. His orders are up 50% on the memory side. And the one snippet I want to leave you with on ASML is that on the new tools they're selling at an average selling price of 120 million euros, they're now selling them on allocation because they can't meet the demand that's coming through from the likes of TSMC and Samsung and so on. So again, that's the name I believe we'll be owning for quite a while. Wärtsilä, the leading provider of diesel engines and backup power for both energy as well as marine. We saw the CFO 3 weeks ago. The thing I really liked about this one, the marine market has been in a downturn for 5 years. It's now turning. In Q3, the marine revenues were down 16%. Their order book was up 35. So that's going to go up next year. We'll see strong growth on the marine side, and the service business is going to accelerate as well. Caring, I've already touched on. Unilever, you might find is boring, but actually, again, we think they're extremely well placed at the moment. They obviously had a big wake-up call when Kraft Heinz came after them, which has led to big culture change in the group. They have to prove to shareholders that they can create the value that we would have received from the Kraft Heinz bid. So they're doing the utmost at the moment. Paul Polman, the CEO, was in Edinburgh 2 weeks ago, and the one stat I liked was that when you look at their emerging market business, that's Unilever, which is 60% of the group, on average over the last 25 years, it grew by 9% a year. Now, more recently, that has been slower, but what we're seeing currently is it grew 2% in Q2, it's growing 6% in Q3, and he was telling us in Q4, emerging market growth for them is going to be 7 to 8%. Now, on 60% of your sales, that already gives you a really nice tailwind for the rest of the group as well. So again, a name we really like. SAP, again, one of the global leaders in software. I think they've got the must-own product when it comes to data analytics and real-time retrieving of data. And we've been told so by a number of their clients who come through our offices on a quarterly basis. They were talking about their cloud bookings being on dynamite for Q4. So another example of a company talking about acceleration of demand in Q4. And then lastly, Richemont reported last week. We saw a bit of profit taking, but when you look at the underlying numbers, I thought they looked perfectly fine, growing 15% in jewelry, 14% on the watches side. The margins seeing nice uplift. And I'm still convinced that the medium-term outlook on the jewelry side in terms of growth and margin accretion is underestimated. That's just to give you a brief overview. They are our highest conviction positions. And maybe we just conclude at this stage. So just to recap, as a firm, we're very committed to South Africa. We're here to build long-term business as well as long-term relationships with clients like yourself. You know, the secondary listing of the Greater European Investment Trust gives you as local investors access to an actively managed and high conviction, concentrated portfolio of the most compelling investment cases in Europe. And that comes at a time when we see Europe as a region showing very strong recovery momentum, both in terms of macroeconomic growth as well as the reform agenda in the individual countries and Europe itself. And maybe we open it up for questions at this stage. Okay, we've got the first question. So what's the total expense ratio for the fund? So it's 1.1%. You basically have a management fee of 0.85%, and then there's a slight addition to for admin costs, administration costs, operating costs of the trust company. But I believe we do have a breakdown of the costs on one of the slides. Let me just try and find this for you. So you can see it here. So you see the management fee, and then there's custody fees and some other fees that brings the total expense ratio up to 1.1. I hope that answers the question. Okay, any other questions on the line? We'll give it a bit of a minute or two.
That's because you explained so well.
Yeah, okay. Well, there don't seem to be any more questions. So thank you very much for your attention again today. It was a real pleasure to present to you. And if there are any other questions, please get in touch with PSG Capital directly. Thank you.